What's up, you guys? It's Greg. I'm going to take you through my investing strategy for the rest of 2021 going into 2022. Now, honestly, I've been following the stock market. I haven't necessarily been really enthused at anything that's going on there. I still think companies are a little bit overvalued and don't necessarily think that that's where I'm going to be putting most of my money. I do have a little bit of crypto still, and I'm definitely going to be watching that as that continues. But I think we're going to be able to get some really good deals in real estate coming up. So let's jump over to the Redfin Data Center. If you want to look at this chart with me, just Google Redfin Data Center and it will come up. It should be the first link there. So the new listings that we see listed here are pretty much on par with the other years that we see. And this really isn't where I'm kind of spending most of my time looking. Next, let's look at the new listing median price. Here was that parabolic moving at the beginning of 2021. And then it's kind of just flatlined from there. So prices are still high, but they're not necessarily coming down, which is interesting because if you look at the pending sales, there's been a sharp decline in pending sales, meaning that less homes are going under contract. And they're just kind of coming back down to a normal level. Typically, we have this taper off, September, October, November, December, kind of like when school starts. Basically, people want to kind of get into homes during the summer, and then things slow down from there. But this is a pretty sharp decline here. But the median sale price is still going up, meaning that even though the new listing median price is staying the same that we see here in this chart, the median sale price is going up still, meaning people are still paying over asking price for these houses, which means that homes are going to start sitting a little bit longer just because the buyer fatigue has happened. Meaning, when I say buyer fatigue, I'm meaning these buyers that are going in, spending their weekend, getting prepared, envisioning their family moving into this house, their kids growing up there, only to get outbid by 30 grand, all cash offer, no contingencies. So I think that with this buyer fatigue happening, we're going to see houses sit a little bit longer, especially the houses that really shouldn't be selling high to begin with. And I'm going to go ahead and show you an example of a wedge deal or something that I would buy, because regardless if the market's on fire or the market's in the toilet, I need to get a good deal, meaning I need to get something under current market value so that I know that I'm hedged against losses, basically, meaning that I am going to make money regardless. I think another thing to keep in mind is that money is still cheap, even though there's been some inflation concerns, with used cars and just the overall CPI data. I think we're at 5%. So basically, the Fed was talking about raising rates potentially, even though they'd said that they weren't going to raise them until 2022, maybe 2023. But then again, if you see here, on July 21st, they actually lowered interest rates again, which makes money even cheaper. Because typically when you see a 1% drop in interest rates, the average home buyer can afford about $10,000 more in a home purchase, meaning that their monthly payment will stay about the same. Because a lot of people look at it strictly from a monthly payment standpoint and not necessarily a total price. So we've got a couple factors working. The eviction moratorium is going to end. The mortgage forbearance is going to end. Buyer fatigue, meaning that the market isn't quite as hot, meaning there's not as many buyers coming in and trying to buy these homes. So homes are maybe only getting a couple offers as opposed to 50, 60 offers. I'm seeing more homes pop up on Hubzu, auction.com, HUD Homes, and places like that that'll kind of satisfy the flipper crowd with the more cheaper, severely distressed homes, as opposed to those homes just sitting because they weren't allowed to be foreclosed on. So this is an example of a house that I would be interested in buying. It's listed at $59.9. When I was running my comps, realistically, after repair value, I would say $170,000, $180,000. I actually own a rental just down the street from here, so I kind of check up on both. If I do end up getting it, if I don't end up getting it, I'm not going to bleep out the address, but if I get it, I'll probably bleep out the address just because, we'll be working on flipping this property. So I'm just going to go ahead and run you through it on kind of what you're looking for in a major wedge deal. Sometimes people like to buy just paint, carpet, cosmetic fixes, and things like that. I usually like to get ones that have a little bit more work so I can make a little bit more profit on them. But as you can see, it's not terrible. The floor's fat, 1,700 square feet, 4-bed, 2-bath. This is rough. I'm gonna be honest, it's pretty rough. The kitchen's okay, although if I get it, I'm gonna end up gutting it. Other than that, new floor, well, I gotta fix the roof. That's a big issue. I gotta fix the roof there. That's actually on the first floor, and the roof's leaking through the second floor as well. So that's not exactly good. New bathrooms, paint, drywall, carpet, some luxury vinyl plank, stuff like that. And the roof. This is that second story there. So a lot of water damage in that aspect. But yeah, so this is an example of a house that you'd want to buy in this market because you can put some money into it and make a massive profit. And that's why I'm getting excited again, because these are the type of houses that I like to buy, and I want to make sure to get in there and flip them so I can sell them, hopefully before the market falls too much more, if it does fall. But I'm just going to show you an example that even if it does fall, why it's not necessarily the end of the world. I'm going to pull up on the iPad here. Let's just say, for example, this is 2008, just so you're kind of aware of what's happening. This won't happen again, but just as a stark contrast, just so you're kind of aware of the thinking behind it. So let's say right now we are right here in the market. We won't know that the market's going to fall. Like, let's say it does fall. And this is why I think real estate's a safe bet, because for me, I can kind of think and process through this in order to hedge against loss. So my ideal situation, that if this did happen again, and this wasn't 2008 and this happens in 2021, would be to wait for the market to start to fall, and then buy here, and then average down by here. And then we won't know exactly where the bottom of the market is. So let's be honest, I probably will wait again and then buy here. But to me, that's so much better than buying, we'll use diamonds as a second. So let's say I wait, and then, well, diamonds then didn't work at all. That was terrible. That was a terrible diamond. So let's say I buy here. So even though I'm getting a better deal, if I average up than if I would have bought at the top of the market, like let's say right here. But if I average up and I buy here, here, and then I buy here, my overall cost is going to be still significantly higher than if I would have bought on the way down. So I think as long as you're buying deals like this one, you can still make money regardless. Because let's say I buy this one, the market crashes. I know for a fact I can rent this house for at least $1,900 a month, maybe $2,000 a month. Because like I said, I own a home right down the street that rents for $1,800 a month, and it's smaller than this home. So that's kind of my strategy, is make sure to buy below market value deals. I think we're gonna start seeing more of those as the time goes on. I'm gonna make sure to get a really good deal on those, because worst case scenario, if I can't sell them, let's say the market absolutely crashes. Well, typically what happens when a market crashes, more people go to rent because people are afraid to buy houses because of the crash, or interest rates goes up, lending requirements become greater, so less people can actually get into houses, so therefore rental would do really well, meaning I need to get it for a good price, get it rented for a good price. Worst case scenario, I keep it as a rental, it still cash flows, and then I cash out, refinance, and pull all of my money out of that property and then sell it at a later date, which is not ideal. I'd rather buy it now, sell it at the very top of the market. You know, if there is a price correction, you know, I'm kind of planning for that. But if there's not a price correction, then that's really great, because I don't think that there's going to be some massive $20% price correction. We might see a 10%, we might see a 5%, just kind of as buyer fatigue happens. You know, if they raise interest rates, then prices for houses will definitely come down. But as long as I'm getting a good deal, I'm very happy with that. I'm looking for single family flips at this moment. And being in New York, I don't want to take possession of a duplex or a fourplex and not be able to evict the tenants. So I'm sticking to single family flips for right now, and I will only hold as a rental if I have to. So for me, I think that these gains are greater and safer than if I was to buy stocks or buy crypto. But keep in mind, this is not financial advice. I'm just a guy on YouTube. So don't let my opinion influence you, and don't copy my strategy. Hopefully this video is helpful. Thanks for watching. Make sure to browse the channel and subscribe. I'll catch you next video.